Welcome to FXTech's comprehensive NZD USD analysis covering November 10th through 15th, 2025. In this presentation, we'll examine the New Zealand dollar's dramatic weakness against the US dollar during a critical week that saw the Kiwi emerge as the weakest G10 currency. We'll analyze the labor market collapse that triggered a 91% probability of an RBNZ rate cut, explore the technical breakdown signals pointing toward the critical 0.5500 support level, and provide actionable trading strategies for both short-term and medium-term horizons. Whether you're an active Forex trader or a market analyst, this report delivers data-driven insights from 5 major Forex sources including TradingView, Investing Live, Action Forex, Forex.com, and Daily Forex. Let's dive into the analysis prepared on November 17, 2025. The New Zealand dollar has emerged as the weakest major currency among G10 nations during this analysis period. Currently trading at 0.5680, NZD USD is consolidating near multi-year lows within a narrow weekly range of 0.5650 to 0.5730. The monthly performance tells a stark story, down 3.8% in November alone, with year-to-date losses reaching a significant 11.2% from January highs. When we look at the G10 currency performance rankings, the picture becomes even clearer. The Japanese yen stands strongest, benefiting from safe haven flows, while the euro and pound show strength amid European stability. The US dollar and Swiss franc sit in the middle of the pack. At the bottom, we see the commodity currencies struggling. CAD, AUD, and NZD ranked weakest. This ranking reflects the market's risk-off sentiment and the particular vulnerabilities facing commodity-oriented economies. 4 critical news catalysts drove New Zero weakness this period. First, Q3 New Zealand employment data released November 5th shocked markets. Unemployment surged to 5.3%, an 8-year high, while job growth stalled at 0%. New Zealand immediately tumbled to weakest G10 currency status. Second, these dismal numbers cemented RBNZ policy expectations, with markets now pricing 91% probability of a 25 basis point cut at the November 26th meeting to 2.25%. This follows a previous 50 basis point cut, with 2026 outlook remaining a coin toss for further easing. Third, AI bubble fears gripped markets as Nasdaq fell 3% in its worst week since April, with Goldman Sachs CEO warning of potential 10 to 20% drawdowns. The risk-off environment particularly damaged high-beta currencies like New Zero. Finally, while the U.S. government shutdown ended, USD weakness proved insufficient to support the Kiwi. The fundamental analysis reveals deeply troubling economic conditions in New Zealand. Labor market weakness is undeniable. Unemployment at 5.3% represents a 70 basis point deterioration from 4.6% just 1 year ago. Zero job growth signals an economic stall, with this lagging indicator now clearly signaling distress. The economy shows increasingly recessionary characteristics. Analysts describe it as a shrinking economy, with the commodity-oriented structure making it vulnerable to global slowdown. New Zealand remains highly exposed to shifts in risk sentiment. These recessionary conditions are forcing the RBNZ into aggressive easing. While there were some positive signals, the BNZ PMI improved to 51.4 with orders at a 3-year high, and negative comments fell from 60.2% to 54.1%. The market dismissed this data, focusing instead on employment weakness. This selective attention highlights how dominant the bearish narrative has become. Despite encouraging economic indicators, positive signals have been completely overshadowed. The BNZ PMI reading of 51.4 indicates expansion, with new orders reaching a 3-year high and business sentiment improving. Negative comments declined from 60.2% to 54.1%. However, markets dismissed these improvements, laser-focused on employment weakness instead. The policy divergence with the Federal Reserve creates a structural headwind for NZD. The RBNZ takes an aggressive approach with 50 basis point cuts and clear easing bias, while the Fed maintains measured 25 basis point cuts. The Fed's December cut probability stands at 70%, showing caution compared to RBNZ's aggressive stance. This widening rate differential creates persistent downward pressure on the Kiwi, as investors favor higher-yielding currencies. The policy gap is expected to widen further through 2026, cementing the bearish fundamental backdrop. The technical picture confirms the fundamental bearish narrative with 4 key breakdown signals. First, strong break of falling channel support combined with achievement of 100% Fibonacci projection at 0.5687 indicates downside acceleration. Technical momentum has shifted decisively bearish. Second, critical support sits at 0.5500, the historical line in the sand where Kiwi has found long-term bottoms. A break below would constitute a very dramatic development for New Zealand dollar. Third, key resistance at 0.5800 continues to hold firm. The pair failed to reclaim this level during November 10 through 15, with each rally failure confirming selling pressure strength. Bearish bias remains intact as long as 0.5800 holds. Fourth, the descending trend line from 2014 peak of 0.8835 suggests major breakdown potential, with technical risks growing for resumption of the long-term downtrend. Let's examine critical technical levels determining NZD USD's near-term trajectory. At 0.5800, critical near-term resistance holds the bearish bias below this level. Current price of 0.5680 represents consolidation midpoint and 5-day moving average. Near-term support sits at 0.5650, forming the consolidation range bottom. The most important level is 0.5500, major support representing the historical line in the sand and long-term bottom area. This will be the critical test. Below that, the next downside target zone sits at 0.5484, 0.5490, representing the 161.8% Fibonacci projection. Finally, 0.5467 marks the 2020 pandemic low and major long-term support. A break of this level would have profound implications for the long-term trend. Traders should monitor these levels closely as they determine whether we see tactical bounce or continued breakdown toward historical lows. For the short-term outlook covering 1 to 2 weeks, we're seeing consolidation within 0.5650, 0.5800 range. Bias remains persistently bearish as long as 0.5800 holds. Most likely trading range is 0.5650, 0.5750. Our strategy: sell rallies towards 0.5750, 0.5800 resistance zone, with stops above 0.5850. Initial target is 0.5650, extended target at 0.5500. However, significant event risk looms. The RBNZ meeting November 26th. Markets expect 25 basis point cut to 2.25% with 91% probability priced in. Key focus will be forward guidance and 2026 easing signals. Volatility potential: 50 to 100 pips. Risk management is crucial. Reduce exposure ahead of November 26th. Use tight stops and size positions for volatility. Dovish surprise could trigger break below 0.5650. Hawkish surprise could spark relief rally to 0.5800, 0.5850. Looking at the medium-term outlook for 1 to 3 months, we present 3 probability-weighted scenarios. The base case, 60% probability, sees gradual decline to 0.5500. RBNZ delivers expected 25 basis point cut while maintaining 2026 easing bias. Global risk sentiment remains fragile as we work towards 0.5484, 0.5490 target zone, testing 0.5500 line in the sand by late December. Potential for tactical bounce from major support. The bearish case, 25% probability, involves break below 0.5500, triggered by additional negative NZ data or more aggressive RBNZ easing. Major risk sentiment deterioration could trigger move towards 0.5467, the 2020 pandemic low. The bullish case, just 15% probability, requires NZ data stabilization, RBNZ signaling easing cycle end, and significant global risk sentiment improvement, targeting recovery toward 0.5800, 0.6000. Weight of evidence favors continued weakness. Global risk sentiment plays a crucial role in New Zealand D performance, and the current environment is decidedly negative. Currency rankings from November 4th through 8th clearly illustrate risk-off dynamics. Japanese yen topped rankings as safe haven demand surged. Euro and GBP showed European stability strength. USD and CHF sat middle pack with mixed performance. At bottom, commodity currencies struggled. CAD, AUD, and New Zealand D ranked weakest as high beta currency. AI bubble fears significantly impacted markets. Technology sector sell-off created risk-off environment, with Nasdaq's 3% decline marking worst week since April. High beta currencies were hit hardest as risk aversion dominated trading. New Zealand D's vulnerability stems from commodity-oriented economy exposed to global growth, high beta characteristics amplifying risk-off moves, and significant Asian demand exposure, particularly China risk. When global risk sentiment deteriorates, New Zealand's highly exposed economy looks even more vulnerable. The balance of risks reveals significantly more downside than upside potential. 5 major downside risks. First, further labor market deterioration with Q4 unemployment above 5.5% would cement 2026 RBNZ easing and likely trigger break below 0.5500. Second, surprise 50 basis point RBNZ cut versus expected 25 would shock markets. Third, intensifying global risk-off from deepening tech sector sell-off would hit high beta NZD particularly hard. Fourth, China economic weakness reducing commodity demand would directly impact NZ exports. Fifth, resuming USD strength if Fed turns hawkish. Upside risks carry lower probability. NZ data stabilization, RBNZ signaling easing end, Fed turning dovish, global risk sentiment improvement, and technical bounce from 0.5500. The assessment is clear. Downside risks significantly outweigh upside risks given fundamental and technical backdrop. Prudent risk management is essential. We conclude with 4 key takeaways. First, fundamental backdrop is decidedly bearish. New Z unemployment at 8-year high, recessionary conditions, 91% RBNZ cut probability, and policy divergence creating structural headwind. Second, technical picture confirms downside. Channel support break, Fibonacci projections achieved, 0.5800 resistance holding, and acceleration toward 0.5500. Third, 0.5500 is critical line in the sand. Historical long-term support where break would be very dramatic, potentially triggering decade-long downtrend resumption toward 0.5467. Fourth, risk sentiment matters. High beta New Zealand vulnerable to risk-off flows and commodity exposure. Trading recommendations. Short term, sell rallies to 0.5750, 0.5800. Stop above 0.5850. Target 0.5650, then 0.5500. Medium term, maintain bearish bias toward 0.5500 by late December. Weight of evidence, fundamental, technical, sentiment, points clearly downward. The question isn't whether we'll test 0.5500, but whether it will hold.